starting in different region on a different day, but most will start by Monday, is highly debated here as well, especially the retail sector, of course, is ringing the alarm bell, especially heading into the so important Christmas season for the sector. But that's essentially where we are here in Germany. We're going to see a lockdown, more or less, on unvaccinated people, and a very swift move right after Olaf Scholz will be sworn in as Chancellor, which might be next Wednesday, to summon the Parliament to get a vote on whether we can get vaccination on a mandatory level as soon as perhaps already February. For now, the booster campaign is going quite well. Also, again, depending on the regions, for example, where I am in Frankfurt, vaccines even were in short supply for a quick moment. Now they did order Moderna, and the booster campaign can go along. But of course, again, in other areas like Saxony, which sees a very low level of vaccination but a very high rate of infections, there the booster campaign is not getting anywhere. So I guess we don't get around that mandatory vaccination, but it is highly contested. It remains to be seen how they are going to enforce it as well. The first Prime Minister of North Rhine-Westphalia was already stepping out and saying, if people are not getting vaccinated, there will be penalties and also perhaps the risk of losing their jobs. For that, over to you.
Yeah, Annette, let me ask you another follow-up question here. It's the one about how rock solid is this coalition, because clearly the new variant now is testing attitudes to how to respond, not only from that libertarian aspect, but also on the economy. Because if you look at some of the data that we've seen recently, the economy is slowing down, particularly around the manufacturing side here. And any more restrictions at this stage, as you've been pointing out, would be very tough on retailers, very tough on the services side of the economy as well. Are the FDP likely to go along with that, given how much more business-focused and business-friendly they are?
You mean, are they going along with more rescue schemes? I mean, probably they are, because there's no alternative. If they're shutting down parts of the population from going shopping, and we are going to see a lot of pain in the retail sector and perhaps even in the hospitality sector as well, because clearly restaurants as well are affected, hotels are affected. You can only go there if you're vaccinated. And also the fact that the vaccination status will expire after 6 months will put additional burden on things, because clearly it's a bit of the hen and egg problem. Because some people just don't get the booster shot because there are no appointments left. And if you're not having a doctor in your circle of friends, or you know someone, then you might actually just not be able to get it in time. I guess the politicians still need to think about that very, very thoroughly. But bringing me back to your question, I guess for at least for that transitionary period this winter, the Liberals will have to do that, and also with Christian Lindner at the top of the finance ministry. But I guess it will be a tough thing going forward, especially with all the spending plans, and whether this coalition will be rock solid remains to be seen. For now, everybody of these people want to be in government. So I guess there's a great will to compromise, but whether the compromise will go as far as spending an awful lot of money on things Liberals don't think it's worth it remains to be seen. But there is, as of now, a big political will to find compromises, Jeff.
Terrific. Thanks so much for that, Annette. We'll catch up with you a little bit later on.
In the meantime, let's take a look at the market action as we count you down to the European session. Signals are weaker. We have red splashing up across these boards early on. In contrast to where we closed out the trade yesterday, a much firmer foothold as we bounced 1.7% on the StoxStrip 600. So we're looking to give back some of that territory first up this morning.
Good morning, everyone. We did close a couple trade on Nasdaq NQ100 yesterday. We went short and we said we're looking for a drop like 10%. We already dropped 3% today. We cover one position here and the second position here, and I'm still holding the third position short. And if the market rally, I'll maybe add short somewhere here or here again. So if it doesn't rally, maybe continue holding the last contract. For gold trade, I'm just waiting. I didn't do anything yet today. Yesterday we did only one trade because the price action was little bit choppy. So we did one trade. So please stand by for gold trade.
In the headlines today, European markets look set to open lower, tracking weakness on Wall Street as the US reports its first case of the Omicron variant. Crude prices rise as the market expects OPEC Plus to slow the supply of additional oil when they meet today, amid fears the new variant will hit demand. And German lawmakers meet today as well to thrash out new COVID restrictions as deaths soar to a 9-month high, with incoming Chancellor Olaf Scholz reportedly favouring a tough line on anyone without a booster jab. And the US threatens sanctions if Russia doesn't pull its troops back from the Ukrainian border, saying it will be ready for all eventualities.
We don't know whether President Putin has made the decision to invade. We do know that he is putting in place the capacity to do so on short order.
We are setting up for a week session here in Europe today. So let's just take stock of some of the other markets. Asia today has been picking up on that lead from Wall Street, where news of the variant reaching the United States caused markets to sell off late in the trade. Japanese stocks are picking up on that trade, as you can see, traveling south by 0.6%. And even across the China markets, where we saw a little bit of green splashing up, and that's now giving way to a little bit of red ink. Hong Kong supported, though, and one of the big stories has been the big property developers tapping the market for funds, which suggests some liquidity constraints may be easing on that sector. Here in Europe, we are facing some red ink, and you can see 1% off some of the major averages. This on the back of what was a very strong session yesterday, particularly on Germany, France, where we saw bounces are close to about 2.5%. So a give back trade is still anticipated, but don't forget, if we think about the risks, we're still waiting out for the scientists to decide what the impact of the new variant is on vaccines, and also the severity too for the unvaccinated. So still a lot of question marks around the variant. US futures are showing us a little bit of that volatility still after a big sell-off late day yesterday. The market looking to claw back some of those losses. So a day in the green is anticipated, at least morning session at this stage. But still, I think we've got other themes to deal with as well around inflation, just how hawkish Jay Powell may be at this point, and the repricing we're seeing on bond markets. So it could be a fascinating session today. Later on, Jeff.
Let's talk about the oil market. Prices are recouping some of Wednesday's losses as expectations mount that OPEC Plus may halt its production hikes amid fears the Omicron variant will drag on global demand. OPEC Plus members will meet later today to decide whether to release more oil as planned or change course. The Turkish finance minister has resigned after just over a year in the post. He will be replaced by Nuruddin Nebati, who has publicly defended the president's unorthodox policy of cutting interest rates amid surging inflation. The Turkish lira has lost nearly half of its value against the greenback this year, much of it just within the past month. And the departure of this finance minister, it would seem, ultimately marks the last senior cabinet member who actually believes in orthodox economic policy. So now largely I think the government that exists and the new finance minister are in line with President Erdogan's view that you can cool inflation pressure by actually cutting interest rates at this point. And of course, when you do that, the clear outlet for investors to take out their dissent is the currency. And as the currency is free floating, I think we're down 44% across the year, and just across the last month, we are down, 27%.
He's a loyalist, isn't he? If you look at some of the background for this new appointment, he was very close to Erdogan's son-in-law and was very vocal in praise. Thank you to Dineo for sending out what has been a very detailed report about this. They also suggest that you'll see a substantial weakening now of fiscal discipline in the months ahead, that Erdogan needs to regain popularity. So Dineo, with its finger on the pulse here, talking about what's going to likely play out on the ground in Turkey. And we know it's been a very difficult crisis. Fiscal support has been one way to appease populations that have been hard hit by the pandemic, whether it's actual impact from being infected with the virus or restrictions, and the other part around supply chains, inflation, and general business demand. So there's been many different layers to the crisis. And in Turkey's case, it seems as though Erdogan feels as though splashing the cash might be the best way to ensure support.
The trouble is you are making the livelihoods of most Turkish workers worse. As you continue to cut interest rates, you increase negative real yields effectively, and this inflation then eats away at your take-home pay. It increases the cost of servicing foreign debt, and it's a slow road to impoverishment, which is actually getting faster the more negative those real yields become. I just don't understand, and a lot of other people don't understand, why at this point the president should feel that this is the correct policy mix to achieve a pickup in prosperity, because that apparently is the avowed reason for doing this, that you are going to make the cost of borrowing cheaper for business and consumers by cutting nominal interest rates. But of course, the reality is when inflation is running this aggressively through the economy, you're doing the opposite.
Yeah. If you think about the timing now, this time round, what's different? Well, can we bank on ultra low rates as far out as we can see on the horizon? We've got slightly more hawkish powell at this point. If you look at the ascent of dollar versus the lira, I mean, there have been many other moments in time when investors have had cause to take flight too from Turkey in recent years. Yeah. But we've got an extraordinary run over the course of this year. And as we always talk about, very sharp moves in a short period of time is very difficult for anyone to navigate, particularly business people. And if you're trying to conduct anything that involves the dollar and international imports, exports, it makes it incredibly challenging. So I think these sharp moves are something to take stock of. The reason we often talk about EM too is whether something can rattle the cage for global markets, where there's a signaling function here. And perhaps there is. I mean, is Turkey something that other emerging markets need to be wary of at this stage because of that dollar strength story? You're leaning against what is an incredibly tough tide here, and the policy choices for Turkey, is that a lesson to other emerging markets not to go down the same pathway?
Well, I mean, for the broader EM theme, of course, every situation is different, and you've got to look at those on their individual merits. But because a lot of people treat this as a block investment, there will be those who will say, well, you know, if Turkey is going to be a drag on a blended index of emerging assets, then why bother? The risk here is obviously that we end up with some kind of civil strife and disturbance on the streets, that Erdogan then uses that as a trigger to take further draconian measures. And then we see a postponement of elections that increasingly are being discussed. The opposition itself is saying, let's go to early elections now and let's have an opportunity to reset economic policy, and let's put the economic policy up for a vote of the people. But of course, you know, unlikely at this stage that is going to happen. I think the concern now for anybody that's not specifically playing the currency but is invested in individual stocks in Turkey is, are we going to see a series of defaults as a result of businesses struggling to meet their foreign currency debt obligations? And that would be something that I think would make emerging investors more broadly very nervous, because we know that Turkish companies are not the only companies that have borrowed on the binge of low interest rates since the global financial crisis of 2008. So maybe it's not countries that we need to worry about specifically, it's corporates that have borrowed heavily in dollars.
Yeah, and just quickly, if you round it out and think about at an index perspective, I think Turkey has proven itself so unreliable. It's really slipped down the weighting of some of those major indices. And perhaps this is another twist as we talk about representation there. Maybe Turkey is just not going to be part of that EM space very much as we look at those global indices. And let's push on anyway, as the US has urged Russia to withdraw its troops from the Ukrainian border or face further economic sanctions. US Secretary of State Antony Blinken is set to meet Russian Foreign Minister Sergei Lavrov today in Stockholm on the sidelines of a summit on European security. According to Ukraine, Russia has deployed more than 90,000 troops near the shared border, with Moscow accusing Kiev of pursuing its own military buildup. Speaking at a meeting of NATO foreign ministers in Riga, Blinken said the US must be prepared in case Russia invades Ukraine.
Now, we don't know whether President Putin has made the decision to invade. We do know that he is putting in place the capacity to do so on short order, should he so decide. So despite uncertainty about intentions and timing, we must prepare for all contingencies while working to see to it that Russia reverses course. We've made it clear to the Kremlin that we will respond resolutely, including with a range of high-impact economic measures that we've refrained from using in the past.
NATO's Secretary General Jens Stoltenberg echoed Blinken's message, saying the organization is prepared for any developments.
So we have a wide range of options to make sure that Russia will be confronted with serious consequences if they once again use force against an independent sovereign nation, Ukraine. Everything from economic sanctions, financial sanctions, political restrictions, but also, as we saw after 2014, when they illegally annexed Crimea and continued to destabilize eastern Ukraine, support the separatists in Donbass, that actually triggered the biggest reinforcement of our collective defense since the end of the Cold War.
The warnings come as Russia arrests 3 people it accuses of being Ukrainian intelligence agents, saying one of them had planned to carry out a bomb attack. That is according to Interfax. So well, these are very serious allegations that have been lodged by Blinken, effectively saying that Russia has made plans for a large-scale attack on Ukraine. This is not helpful as we talk about so many complex factors for markets at this stage for investors to contend with. A geopolitical fallout of this nature is extraordinary.
It's just one more thing, isn't it, on top of everything else that we've got around Omicron and concerns about just the recovery and how strong it is from 2 years of stop-start closing and opening of economies and the supply chain shortages and the consequent inflationary pressures that we're seeing here. But it's not only in Russia, is it? I mean, one of the other stories that we're keeping a weathered eye on this morning, the Chinese in Beijing have summoned the Japanese ambassador for a bit of a hauling over the coals for the comments that Shinzo Abe made about going to the defense of Taiwan. And all of these things just create a broader sense of unease among investors as they think about whether they take advantage of any sell-offs to buy the bounce or whether they sit back and wait to see some of the confusion clear. And unfortunately, I don't think there is going to be a lot of clarity, is there? Because it does seem to be in the interests of both the government of China and of Russia at this stage to create uncertainty around geopolitical actions. And you know, they will have their own perspective on what is going on, particularly Vladimir Putin's government over the situation in Ukraine. But my understanding is that Volodymyr Zelensky has appealed for talks to make some progress on diffusing this increase in troop movements at the border, and that the Ukrainians have only responded, in a sense, to what they've seen as a build-up of troop support for the separatists in the Donbass region. Maybe I'm wrong. Maybe that's not how things have played out, but that appears to be what has taken place at this stage. Let's see some sensible discussions take place through the OCSE today. Let's break some bread. Let's diffuse.
It's fascinating because one of the other big economic stories we've been talking about in the region has been Nord Stream 2. So how does that fit with escalating tensions? I think the messaging was very strong as we've seen this fuel or this energy crisis in Europe. The message to Vladimir Putin has been very clear from the Europeans. This is not helping you get approval for this new oil pipeline, or gas pipeline rather. It's not helping. That if there's any restriction of product already, tightening the noose on Europe around energy is not going to get you anywhere quickly. But same thing too, you've got to say, with geopolitical tensions on the border with Ukraine, it's not going to help Europe decide that they want more product and more reliance on the Russians when it comes to energy.
Yeah. Cynically, you could make the case that the Russians are unhappy about the fact that the licensing of the new pipeline has not already taken place, and they are looking for a bargaining chip here to get that license approval, and perhaps agreeing to step back troop movements and de-escalate might be that bargaining chip to get the pipeline licensed and open. But that would be a very cynical view of how great power negotiations take place. I just want to point out that we do have live pictures from the OSCE meeting in Stockholm, where hopefully we will see some progress in a conversation between Secretary of State Blinken and the Russian foreign minister. I don't want to build up expectations because I think we're all just neutral on this and hoping that there will be some significant movement. But at this point, what we do know is that the latest news that the Russians are putting out is this claim, I think, Karen, that you mentioned, that they've arrested 3 Ukrainians in inverted commas over a bomb plan. But this is all just very reminiscent of a lot of the info war that we get every time there is a story that involves the Kremlin. Well,
let's hope the spirit of Christmas will prevail. And we saw very festive arrivals there for both sides with all the Christmas trees and the green carpet. So let's hope some festive cheer might row back some of these tensions.
What a season of goodwill to all men and women. Let's take the break. We'll be right back, everybody. Apple's Asian-listed chip suppliers take a tumble as the iPhone maker reportedly warns of weak demand. We'll be right back.
Okay, so far we are been sideways around this line. Just want to see if this line will hold or not. So far, there's no green candle around this line. That's why I'm just waiting a little bit.
Asia-listed Apple suppliers are trading lower after the tech giant reportedly told component makers that demand for the iPhone 13 has slowed amid longer wait times. That's according to Bloomberg, which cites people familiar with the matter. The company has already cut production of its latest smartphone by 10 million units due to ongoing semiconductor chip shortage problems. Just last month, CEO Tim Cook also warned that the impact of supply chain issues could get worse during the critical holiday season. HP Enterprise CEO and President Antonio Neri says stakeholders must adopt drastic measures to ensure technology is sustainable. Speaking at the 5th Annual Conference of Paris, Neri told me that public and private sectors must collaborate.
We believe technology is going to revolutionize everything in our life and in our business. But we have to take a very radical, different approach in solving these problems in a sustainable way. When we talk to customers, they are now more aware about the need to develop technologies that advance business outcomes for the explosion of the data we see everywhere. But at the same time, they're demanding that we do it in a sustainable way, lower consumption, lower carbon footprint. And we as a company obviously play a huge role because we innovate in ways that others can't. For example, when you think about that data explosion, we need to think about the future of computing and have to use less energy. When we think about where the data is processed, more and more is processed at the edge where we live and work.
Antonio Neri there with me. Well, we are counting down to the start of the European trade, and already we are bracing for some rating this morning. Signals are weaker across some of the French, German and UK markets, in contrast to very strong trade yesterday. So watch and wait for the give back trade in a couple of minutes' time.
You can see every time it turns green, the next candle will be red. So every time it turns green, next one it will be red. Like the buyer, they have a problem to take over. I'm just waiting for the right moment. We saw this for last 5 candles. It turned green, then the green disappeared. it's very important before you go long or short, you watch the price action. You can feel it, you know. It's not just buy or sell. You just need to watch it a couple minutes to get the feeling. Who's winning the game, the buyer or the seller?
European stock markets are open for trade, and the early signals have been weak. We've had a lot of choppy market action, not just here, but also stateside as investors take stock of very mixed messages, one around this new variant, and we are still waiting to determine what the impact may be on the economic story. Scientists trying to work out the impact on vaccines, efficacy, on the severity of symptoms, transmissibility. All those answers are still yet to be handed over to markets and for investors to determine the impact. And the other big messaging here has been around interest rates. Jay Powell has done effectively this pivot and become a lot more hawkish around pricing pressures, and that has just caused a bit of a wobble on some asset classes as well. So the market dealing with twin themes here. In stateside, we saw the US trade roiled by the first confirmed case of Omicron in the United States, even though we're starting to see it crop up in so many different countries at this point. Now, here in Europe, we did have a bounce. We were back in the green yesterday very strongly for some of these markets, but it seems as though that may have been a little bit early given that trade in the States late days. So we are handing back a lot of that territory, as you can see. We are slumping close to 1% at the start, in contrast to the pop of 1.7% in trade yesterday. Now, the sector's broad-based sweep lower. Every sector trades negative. Healthcare at the top, travel and leisure at the bottom. And this area of the market hard hit yesterday in the United States, falls of roughly about 7% for some big airline players and also in the cruise ship business. So this sector, which has still been dealing with those varying concerns over the course of this week, every stock in that sector trades weaker at this stage. And we have falls of between 5% and about 1% at this point. The technology basket trades lower. This is the interest rate story that we've been talking about. Concerns that we might see a lift-off in rates stateside next year, but also concerns around the supply chain. Still, in Apple, the latest to warn about some of the slipping demand that it's seeing for the iPhone. That impacted the Asian suppliers. It's impacting some of the European suppliers today. And you can see the sector itself is down 1.4%. Financials, basic resources, all traded down more than 1%. So we do have some fairly significant pullbacks here. Autos are similar tune, down more than 1%. Every stock just about there trades lower. Renault right at the bottom. Retail stocks moving south. M&S right at the bottom. We've got industrials shedding 1% as well. Oil and gas down 0.9. Every stock in that basket trades weaker, along with media down 0.7%. Insurance stocks reversing. Chemicals, one of the better performers, but still off 0.5%. And healthcare just below the flat line at this point. A little bit of green still in some of the names, but it is a weaker start in Europe today. Let's take a quick look at what that means at index level. We've got the UK market travelling at 7,113, down about 0.8%. It was up about 1.5% yesterday, so giving back half of that territory. So just worth remembering that trade, because I think yesterday was very relevant. The amount of green we captured to the upside. The French market in particular was trading up about 2.4+%. So we're giving back some of this, not all of it, in the early part of the session. The DAX just opening as well. It was up a similar tune to the French market, also swiftly shedding about 1% 15,294 the trade. On the periphery, similar tune, and you can see the SMI more supported thanks to that healthcare performance this morning. Let's take a look at Air France KLM, which is reportedly considering shelving its planned capital increase. The French-Dutch carrier was hoping to raise 1 billion euros by the end of the year, but according to sources speaking with Reuters, tougher travel restrictions caused by the emergence of the new Omicron variant are forcing a rethink in the stock travelling south. 3-month view still weak. It's been down 6%. Well, shares in travel companies around the world have plummeted since news of the new variant broke. And here's a close-up look at the sector. EasyJet showing a little bit more green, a bit of support today, but elsewhere it is a weaker trade. Wizz Air's down 2.5, Ryanair similar tune. Air France KLM is one of the ones down heavily. And I think IAG, we saw it very swiftly move into the trade when the variant news first broke, that 20% slump, and then clawing back from that picture, it is down modestly in session today. I want to get to that big technology story as we talk about supply chains, as Apple has reportedly told component makers that demand for the iPhone 13 has slowed amid longer wait times. The company's already cut production of its latest smartphone by 10 million units due to an ongoing semiconductor chip shortage. Just last month, CEO Tim Cook also warned that the impact of supply chain issues could get worse during the critical holiday season. So we are seeing a pullback of 2 to 3% across this space today. American-Swiss pharmaceutical company Novartis is holding an investor day. It says it's confident it can reach annual sales growth of 4% each year until 2026. And it's gone on to say it has up to 20 assets in its pipeline with expected sales of around $1 billion. So some fairly upbeat remarks today, lifting the share price. And UniCredit may announce further cuts to its workforce. According to two sources speaking with Reuters, the Italian lender is considering losing another 3,000 jobs, or about 3.4% of its overall workforce, through voluntary departures. CEO Andrea Orcella is reportedly set to outline the company's 3-year strategic plan on the 9th of December. The stock retreating with the broader market today. And this is a group which says it expects midterm margins to be higher, between 4 to 6%, as its restructuring plan continues. The German industrial giant is looking specifically at the marine systems, cement plants and chemicals divisions as it weighs potential consolidations and partnerships. The group has already sold a number of its businesses in the past year as part of a structural overhaul, and it is moving south at 0.7%. Let's push on to GSK, as Britain's drug regulator approved a new antibody-based COVID-19 drug developed by the company along with Vir Biotechnology. The medicine will be used for people with mild to moderate symptoms who are at risk of developing severe disease. The company has also confirmed that a preclinical analysis showed the drug works against the new Omicron variant, but added that further tests will be required. The stock, one of the bright spots on the markets today. Jean-Paul Jägers joins us now, Head of Asset Allocation at Barclays Wealth and Investments. Thank you very much for joining us today. We're just pointing out pretty much throughout the show there's so many complex issues for investors to contend with, competing themes around this variant, which we don't know about at this stage, and a much more hawkish Fed at this stage. What are you doing on the markets? Are you just sitting back, waiting for some more developments?
Hello, good morning. So yes, we indeed see that the investors are getting more anxious, and as you have been pointing out, indeed it's a mixture of headlines making investors a little bit more uncomfortable. But what we do try to do is zoom a little bit out and think of where we position portfolios a little bit more longer term. So in terms of equities, we're still leaning into equities. We still think that economic growth is strong enough. Yes, we see it slowing a little bit, but we still think there will be a few quarters of decent growth. We also see that if we look to monetary policy, still accommodation is very, very loose. If we look to real yields, we still think there's an environment that is supportive of equities and still enough for earnings. And if we look to investor sentiment, we still think investors still see it as the glass half full instead of half empty.
Bank of America yesterday was talking about a rate shock in 2022, which was one of the stronger calls we've seen out there. What did you make of that? And do you think there is potential that we've got either the market moving more aggressively on market rates or Powell moving on interest rates?
Yes, clearly we have seen central banks shifting in tone a little bit with the elevated and rising inflation. Inflation has been coming in a little bit stickier and a little bit hotter than expected. Of course, central banks are now tilting the upside risks as well. We know there is a time element, so the longer inflation stays a bit higher, the more the risk it will be seeping into expectations or societal consciousness. We actually think there is a risk that the Federal Reserve might go a little bit faster than is expected. So that's one of the reasons why Barclays we're shying away from emerging market currencies. We think it will weigh on in our portfolio on an emerging currency bit. And in particularly in the UK, we think the Bank of England, the tone of a little bit more hawkish potential, we think will weigh on sterling.
That's interesting. So what do you think about owning UK listed earners in overseas currencies? Because if your forecast is correct, they ought to do better over the earnings season, particularly from the conversion.
Yes, that's a very good point. So What makes our life a little bit easier is that we can do it independently. So for us, it's easier to have a view on sterling and have a view on equities, for example, that do it indirectly, where you have all kind of potential for hedging or translation mismatches. But indeed, in portfolios, what we have been doing is selling down sterling exposure a little bit. We think if the Bank of England will lift off in the face of slowing growth, with a lot of uncertainties in the dynamism in the labor market, potentially a bit through Brexit and the workforce elasticity, we think this will be taken as a negative. But there are indeed, as you say, multiple ways you could express this in portfolios.
Jean-Paul, we're very focused on the Turkish lira at the moment, and obviously the currency's weakened again a little bit here on the fact that the finance minister has left and been replaced. This morning, the central bank governor reportedly talking about the strength of the current account and obviously trying to prevent the currency declining much further here. Do you think there is any risk of contagion into other EM currencies and local currency debt? I know you're not a big fan of the EM currencies, but you are quite interested, I think, in EM local currency debt.
Well, that's a very good point to make. So indeed, in Turkey, what we've seen is a very aggressive sell-off of the currency. And in that sense, the situation in Turkey is quite unique if we look across the emerging complex. If we zoom out a little bit, the big picture, we still think that emerging currencies in general will be under pressure. So in that sense, the situation in Turkey is in that sense isolated. And so far, we've actually seen very little contagion effect across other emerging currencies so far.
Can I ask you about central banks this month? Because as we look at all the major ones now, we've got the Fed again saying it will discuss whether to alter the program, its taper program, earlier in light of the strength of the economy. We've got the ECB expected to revisit its PEP program, and we've got the BOE with a live meeting too around rates. What sort of risk event are we setting up for in a couple of weeks?
Oh, that's a very good question. It's the tone in general we have seen is central banks switching and allowing a little bit more for upside risk in inflation. So they look to various outcomes and they actually said the upside risk for inflation to remain a little stickier and hotter than expected is a risk to any outlook. And that's a general shift we have seen across central banks. The message on taper, we actually as a house think is less important in our investment decisions. For example, last year we had a very aggressive taper where the Federal Reserve slowed down the pace of purchases quite aggressively, which was largely unnoticed in markets. So in that sense, it's more a little bit of a psychological effect where initial reaction of investors, but we don't think for the investment case it changes a lot. We have been positioning a little bit for upside surprises to hawkish tones from central banks, and would still expect, so far what we know with the current data, is that the UK and the Federal Reserve will start lifting rates in the next few months.
I'll ask you about the oil markets and what you're doing there, because some may see a re-entry point at this stage. We're talking to one investor who thinks that the demand story is compelling, even if you're still weighing up the ESG concerns, or investors don't want to be in that space at this point. They think demand outweighs that story at this stage. How are you viewing the oil markets after the retreat?
So if we look across the multi-asset space, we think what we've seen in oil in the recent few days has been quite aggressive. So if we look at price actions, we think that if we look across the different assets, it has adjusted very significantly. It's not something that we can easily invest in for the type of clientele we're managing the portfolios for, but we do have a significantly increased our general diversified commodity exposure at the start of the year. That was part of a holistic approach, where we want to have a little bit more inflation protection in portfolios. So that was commodity and inflation linkers where exposure has been increased. So we do own energy in our commodity complex, but it's not something at the moment, we're having very high conviction in either way.
We're going to wrap it up. Jean-Paul, thanks so much for being with us. Jean-Paul Jagers, Head of Asset Allocation at Barclays Wealth and Investments. We're just going to take some live pictures of Antony Blinken, the US Secretary of State. This is at the OSCE security meeting. The expectation is that we are going to have some discussions between US officials and Russian officials, and hopefully we'll hear some more positive noises from Stockholm around a de-escalation of the situation with Ukraine and Russia on their shared border.
our NATO allies hold as well. That was very, very clearly evident in the conversations that we had over the last couple of days. We have the deep concerns about the aggressive posture that Russia has taken once again towards Ukraine, and I look forward to talking to you about the way forward on that, as well as many other things that are important in our relationship. But I'm glad to have the opportunity to compare notes directly at what is a critical time.
It's really good to have this opportunity, and I appreciate the discussion that took place yesterday in Riga at NATO summit. I think it's a great coincidence that we have those NATO and OSCE events following each other, because these are the venues which fit the best to discuss the security situation and the way how allies and other European countries can deter Russia from from resorting to a military operation again. As we see, Russia provokes Ukraine militarily, but also diplomatically. We will continue to demonstrate restraint. At the same time, we will continue working and calling on these partners and calling on them to prepare a deterrence package that will make President Putin think twice before resorting to military force. I think that all of us have to be focused on deterring Russia at this point, and we have no intentions to provoke them or to hold any military operations in Donbass. Ukraine is committed to the peaceful resolution of the conflict, and I really appreciate the role of the United States in all of these elements, in deterring Russia in a more broader sense, but also in putting together this deterrence package that will bring together the transatlantic community in order to ensure the full maximum efficiency of measures that may be taken. Thank you.
Thank you. Thanks, everyone.
Thank you.
Mr. Secretary, what will you tell Mr. Lavrov?
Thanks, guys. Thank you.
I suspect, well, let's see if we get any questions for reporters. Doesn't look like it, does it? The press are being shepherded out of the room after those opening comments. That was, of course, the US Secretary of State, Antony.
Guys, did you see what happened now? The market drop very quickly. Even if we have a green candle, but we're still in red, and the market drops. That's why I didn't go long at this black line. So you understand why I didn't go long. Okay? So just be patient.
To defence spending from NATO headquarters without really contributing constructively to the dialogue around all of the conflicts that we are witnessing. So slightly different tone, I think we saw.
Oh, totally. I mean, the attitude towards Russia, I think, has shifted as well. I mean, we all remember that meeting with President Putin and President Trump, where President Trump largely stepped back and allowed President Putin to dominate the event and ignored apparently the advice that he got from his own administration about how he should behave towards President Putin and Russia at that stage. I mean, as you point out, there is always that risk when you hold those very public, open exchanges that it's going to turn into what we saw with President Trump and the head of NATO, where President Trump basically just tore a strip off of NATO and countries that have not made up their contributions to the 2% level.
Friendly fire is not really what you're expecting to be taken out by, and in fact, that's what Trump did a couple of years back. But this is, as I say, it's a sea change, isn't it?
Let's take the break. We'll be back in just a moment. Still to come on the programme this morning, German leaders are set to meet today to talk about a fresh round of COVID restrictions. As cases across the country surge, we'll get details from Germany when we come back.
dollar yen, we said yesterday between 113 and 114, and the price is still holding. Oil market, it was down little bit yesterday. I guess because the coronavirus, they don't know what's gonna happen. Is a lot of countries gonna lock up, or is everything will be normal, you know? So, and plus the US, they using the reserve also. But like I said yesterday, it's Morgan Stanley is still looking, and Goldman is looking for 85 and 90 next few months. So, or maybe take small position around 66. 64. I'm still watching the gold, so I'll maybe take a small position on gold right now, and a small position on oil market, since we don't have anything on gold yet.
Omicron is fast becoming the dominant variant in South Africa, the first country to report its existence. The country's National Institute for Communicable Diseases says it is seeing a, quote, exponential increase in infections, with 74% of virus genomes sequenced in the last month belonging to the new variant. UN Secretary General Antonio Guterres has branded Africa-focused travel.
Just took a position on gold around 66.50. I'm planning to add every 5 points. If we go higher from here, I have a position. If we go down, I will add little bit. Okay. So I'm still watching the gold.
Thrash out new coronavirus restrictions. The meeting comes amid reports that the incoming Chancellor Olaf Scholz is in favour of mandatory vaccinations. Annetta joins us now with more. So, Annetta, what are we going to get in terms of further restrictions, do you think?
Well, we are going to get essentially locked down for the unvaccinated. So from Monday or perhaps Wednesday onwards, they are no longer allowed to go into shops and restaurants, theaters, bars, etc. And there also will be closures of bars and nightclubs in certain regions where the incidence level is far too high and the hospitalization level is also too high. So, for example, in parts of Bavaria, restaurants are already closed. In parts of Saxony, the same holds true, and also in Thuringia. In that part of Eastern Germany, also restaurants and sort of theaters are already closed. So that is what we are getting. But essentially for the vaccinated, nothing really will change a lot. There might be areas where we also need to get tests, but of course the retail sector is up in arms because clearly it's the very important period of the year. And it will mean a lot less sales for the retail sector, because, of course, for the unvaccinated, and that's still, not a huge part, a substantial part of the population, it's not, not possible anymore to go to the shops. Only online will be possible. And talking about vaccination, that's the key issue. Olaf Scholz is quite open about the fact that he will vote in favor of mandatory vaccination in Parliament. So he can't decide it on his own. It's something Parliament has to decide. Most likely we're going to see a very swift action on that front. Once the new government is in place, Olaf Scholz might be sworn in December 8th, and perhaps we're going to get a session in Parliament already this year on the question whether we are going to see mandatory vaccination as soon as February. For now, what is happening is that they are accelerating the booster campaign. For a moment, it looked like that we had actually not enough vaccines around in Germany, but this seems to have changed. With today, the news is that we are going to get more Moderna vaccines in order to speed up that booster campaign. That's it for now. Back to you.
Thank you very much for that, Annetta. Coming up on the show, Italian diagnostics company Diasorin says its coronavirus test is able to detect the newly identified Omicron variant. We're going to discuss that with the CEO, Carla Rosa, right after the break.
European equity markets fall as the Omicron variant spreads fear and the US records its first confirmed case. Travel and leisure, one of the largest losers as countries weigh fresh restrictions, while Air France reportedly considers shelving its proposed capital raising. Crude prices rise as the market expects OPEC Plus to slow the supply of additional oil when they meet today amid fears the new variant will hit demand. And Ukraine vows to exercise restraint, saying it has no intention of provoking Russia as Moscow builds up troops on the shared border.
We don't know whether President Putin has made the decision to invade. We do know that he is putting in place the capacity to do so on short order.
European stock markets have been trading for 30 minutes, and during that time we have seen a reversal in trade from yesterday's much higher ranges as we closed up shop. A lot of green on the boards for the trade, 2.5% roughly for some of these markets, Germany and France. But now we are seeing the other side of that trade. In morning session, we've got fairly sizable drops on both the French, German markets, which were the outliers to the upside. Both are given back 1%. So not all of the gains from yesterday, but still heavily in the red this morning. We had a very challenging handover from Wall Street. We're just in the final stages. The Dow dropped very aggressively from initial hold on around 500 points to the upside to a drop of almost that same amount on the first confirmed case of the Omicron variant stateside. What we've got here in Europe, we've been contending with the variant fears all week, and it's been a very choppy trade anyway. If we look at the sectors now, and you're seeing a number of different themes coming to the markets. It's not just the variant concerns that's impacting the trade around banks and travel leisure, but also concerns around the taper program in the States and interest rates. We've got a lot of conversations from central banks this month, and there are concerns now that central banks may have been on the page of being watching transitory pricing pressures, but now they are very much genuine, taking stock of inflationary pressures next year, and perhaps that sets the scene for tightening while we are still not out of this pandemic. So you can see these twin themes very much impacting the trade. Healthcare at the top, technology at the bottom, down 2.6%. This goes to the interest rate story that I'm talking about, but also a very big narrative from Apple overnight talking about the waning demand for iPhone 13s amid longer waiting times and supply chain issues we've been talking about. Travel, as you can see, not too far behind, down 1.7%. The stocks, here's how it looks at the individual level. Carnival, the shipping business, cruise shipping business, down 5.6%. Royal Mail falling. Deliveroo shedding 4.5%, and ASML is travelling south by 4% in the tech space. As we look to those to the upside, Valeo is bouncing nicely, 2.5% in the green. Italian diagnostics company DiaSorin says its COVID-19 test can accurately detect the new Omicron variant. The group is monitoring variants around the world to improve its testing ability. Joining us now is Carlo Rossa, who is the CEO of DiaSorin. Carlo, thank you so much for joining us. We are all searching for information around this new variant. Just give us a sense of how you're thinking about it at this stage while we wait for evidence about its impact on vaccines from scientists.
Good morning. Certainly, you need to understand that what we issued a couple of days ago about the Omicron and our ability to detect it is something that everybody has to do. Actually, is one of the requests of the FDA. Every time there is a new variant, you need to actually check with the GSAID bank and really making sure that the product is able to detect the variant. As far as diagnostic testing, I think that in terms of volume, we are still, let me say, 30% down worldwide from where we were in Q4, Q1 last year and beginning of 2021. And this, I believe, tells you a lot about the state of the opening and the way that people today are used to live with COVID. Although I believe that we need to wait until the respiratory season will kick in to really understand how much testing will be necessary, because now we are entering into a season where, you know, you do have certainly COVID and Corona, but then you have all the other respiratory diseases. So we really need to wait and see what is going to happen in the next couple of months.
It has felt like it's been very difficult to distinguish between symptoms of cold and flu versus COVID, as we see more twists and turns around different variants. But multi or lateral flow tests have been doing a lot of the heavy lifting lately, at least in this country. What do you make of a U-turn now and a swap back to more PCR tests around this new variant?
Look, as you know, also in Italy, there has been a lot of debate about antigen testing versus PCR testing. And it's undeniable and scientifically proven that a good antigen test can detect between 300,000 and 500,000 copies per ml of the virus, whereas a good PCR test goes down to 500. The only difference, so in theory, you should be using PCR all over. The problem is that, unfortunately, PCR can only be performed today with fairly complex technologies. And so I believe that PCR testing, antigen testing will continue to coexist. And really, depending on the different markets, in the US, there is widespread use. Also because FDA is actually pushing for more home testing, whereas at least in the European countries today, it's not been so common, let me say, for people to get tested before going to a party. But again, that has to do with a lot of policies that different governments are actually pushing to try to contain COVID.
Carlo, when Delta emerged on the scene, it felt very similar. We were very slow to understand just how widespread it was in communities already because of the limited pace of testing. If we take that as our template, do you think where we are now is that Omicron is actually fairly widespread, but again, we are being led down this false sense of security path because the testing is not as comprehensive and as widespread as it should be?
Well, more than testing, it has to do with sequencing. And because, as you know, not all samples today get sequenced depending on the capacity of each individual country is between 1% and 10% of daily positives eventually get sequenced. So I think we don't know yet, really, how many Omicron cases really there are. And certainly what we don't know yet is whether this Darwinian natural advantage that these variants, starting with Delta had versus the original one, we don't know if Omicron will be able within weeks or months really to take over. I think it's a little bit early to make that determination.
You probably are involved in much more interesting conversations than we are with pharmaceutical companies about how to address Omicron. We didn't need a new vaccine for Beta or for Delta. Do we need a new vaccine for Omicron?
I think nobody knows. Again, because this virus, this variant has been discovered recently. And, the majority of the population today is vaccinated. So cases, for example, the one that's being reported on the Italian newspapers has to do with the infection of people that were actually vaccinated. So I think it's a little early, to be honest with you, to really understand whether we have to go down that path of, let me say, a new cocktail for vaccination or not.
Hello. It's hard to think that this narrative around the new variant is going to be positive for vaccine hesitancy, those that were reluctant to get the vaccine, and perhaps anyone who may have a concern about going in to get a booster at this stage. Can you just comment on that? Because it's been a very difficult journey for lawmakers to encourage some people to go into those vaccine centres anyway.
Look, I think we have demonstrated that in the Western world, you get up to 20% of the population that in a rational or irrational way is refusing vaccination. And I think you can just go, it's a political decision that at this point governments have to take. Do you make it mandatory or not? Because I think through evidence and science, you're not going to be able to convince these 20% individuals to get vaccinated. And I think these days, I think this is the discussion on the table. And I really hope, this is a personal opinion, that somebody sooner or later is going to make that step and make it mandatory.
Carlo, thank you so much for being with us and for participating in the conversation. Carlo Rosa, the CEO of Diasorin. Coming up on the program, the World Trade Organization postponing its key ministerial meeting as Omicron fears spread. We're going to talk to the WTO Director General, Ngozi Okonjo-Iweala, right after the break.
are still monitoring events from the OSCE meeting. This is the ministerial meeting that is a headline act in Stockholm today. We've already heard from Antony Blinken setting out the case for where they see the situation on the border between Russia and Ukraine. And the other headline act will, of course, be Russian Foreign Minister Sergei Lavrov. So what we have early on, some green carpet. I think we've at the European level, we've seen red carpet, we've seen blue carpet. Now we've seen green carpet. And we were just saying before, we hope the festive spirit does prevail as we're seeing escalating geopolitical tensions now. And the market was very focused on the Russia motivations around Nord Stream 2, around the energy crisis lately, but now there are concerns around some form of a military buildup and what that could spell for European relations with Russia right on the eve of Christmas. So very important conversations taking place against this very festive backdrop. Well, elsewhere, let's take a look at oil prices, which are recouping some of Wednesday's losses as expectations mount that OPEC Plus may halt its production hikes amid fears the Omicron variant will drag on global demand. OPEC Plus members will meet later today to decide whether to release more oil as planned or change course. And you can see up 1.6% on the price of Brent. The Turkish finance minister has resigned after just over a year in the post. He will be replaced by Nuruddin Nebati, who has publicly defended the president's unorthodox policy of cutting interest rates amid surging inflation. The Turkish lira has lost nearly half of its value against the dollar this year, much of it just within the past month. Despite the plunge, the Turkish central bank governor claimed this morning an investment appetite remains strong and foreign exchange reserves have entered, quote, a stable rising trend.
Curbs on travel have forced the World Trade Organization to cancel its 12th in-person ministerial conference this week, now to be held in March. The meeting was seen by some as a key opportunity to strike a deal on lifting COVID vaccine patents and providing more equitable access to vaccines. We're pleased to be joined by the Director General of the WTO, Ngozi Okonjo-Iweala. Thank you so much for coming back to us on CNBC. If I could just start by the cancellation of the meeting. The Wall Street Journal had a bit of a scathing editorial a couple of days ago where they described this as a face-saving cancellation because, quite frankly, there isn't space at this time to make progress on some of the key issues the WTO needs to address because there's a lack of consensus among leading countries. Is that a fair representation of where we are at the moment on the free trade agenda?
The answer is no. I think that the assessment, perhaps they are not conscious of several of the things that are happening at the WTO. For instance, on the issue of sustainability of the oceans and our fisheries resources, negotiations have been going on for 21 years without result. But for the first time, we have momentum. And we actually expected that at this meeting, we would be able to close the deal with ministers. So the issue is that even though the meeting was postponed through no fault of WTO's, we are continuing work apace. Everybody feels we can really clinch this agreement. So we are going to set ourselves a deadline of after the holidays, early next year, trying to get to yes on this dossier. So that it's not quite correct that nothing is moving. I also want to say that there are other areas. Let me tell you, for instance, there's going to be closure today on the regulation of domestic services, and which it's been negotiated here, but by about 67 countries, and that's a huge one. It's going to save about 145 billion for services businesses with a tremendous fall in costs. In some areas like banking, for instance, computer services, 11% fall in costs. These are estimates that we have, and OECD has also done some work. So just to illustrate two things that are happening. So it's not correct that it was a face-saving measure. No, we had some things lined up to complete.
But Dr. Ngozi, this morning we've been showing our audience live pictures from Stockholm of the OSCE meeting where we have the US Secretary of State, Antony Blinken, meeting his foreign minister counterparts from Ukraine, from Russia. And anybody looking at those pictures will think, well, if they felt safe enough to hold in-person conversations at a ministerial level, why wasn't the WTO willing to hold in-person conversations at your level, a ministerial level, given how important it is that we get some progress on the treatment of trade as it relates to emerging and developed economies, that we talk about the issue of equitable distribution of vaccines and all these so important matters?
Well, let me address that. First of all, the OSCE meeting is quite different. At the WTO, the ministers come in to actually work, to negotiate with each other, not to talk with each other, but actual legally binding agreements that are being negotiated. So there are 164 members, and it has always been the case that if some members cannot be around the table, then it is regarded as totally inequitable to have a group of members negotiating when others are not there. And the point is that 6 Southern African countries were immediately restricted from traveling from their countries into Europe. So everyone knows that. And then many more countries were added rapidly, up to 12 countries. So I do not understand how you would allow negotiations to go on absent 12 countries from the table. How would you deal with that? And it's not the kind of thing you can use technology to do, really, because there are a lot of little side deals and conversations in order to get to yes. So that was one reason. The other is we have ministers and delegations flying in from 164 countries. That's a little different from a smaller meeting. And so the health implications of this, we followed Swiss government guidelines, and it did not seem safe to have all those people arrive here. I think we have to have the health and safety of people in mind first, and then equity of negotiations next. It was a very painful decision. You can imagine that the staff in the secretariat, the members, we've all been working night and day, negotiating night and day. It was a very difficult decision, but everyone here agrees it was the best. We should put people's safety above everything else.
Director General, let's push on and talk about one of the big issues then around the pandemic. The latest twist around this variant has seen border closures for the Southern African nations where this variant has been spreading. But already there have been concerns that this really amounts to some form of economic consequence now, because we're talking about nations where vaccine rates are very low, where there hasn't been the same distribution or access to those vaccines. Are you concerned about the economic implications for countries that don't have the same level of vaccines as developed nations?
Absolutely, I'm very concerned. First of all, I've said it time and again. Let's just take the numbers. We've had 7.8 billion doses of vaccines administered worldwide, which is great. We've been able to produce more vaccines than ever, and so that is commendable. But only 0.7% of this has gone to low-income countries, and for Africa, about 3% of these doses. So the level of inequity is quite high. And we have the work we have done, and the IMF also has done, has shown that recovery from this pandemic, economic recovery, is based on two things: the amount of fiscal stimulus that a country is able to administer, monetary policy easing, along with access to vaccines. Those are the two biggest determinants. In our trade work, we also found the same divergence between countries depending on access to vaccines and the fiscal stimulus. So I'm very concerned that if we continue with the inequity, that will have a dampening effect on recovery in those countries. And if you couple that with closure, not allowing those countries to travel or people to come in, I think that is really, that puts a dampening edge on recovery in many of the developing countries. And maybe the decision to immediately close down, one can understand it maybe politically, but I think it was a bit too hasty, and shut down on the 7 African countries when it wasn't clear whether the Omicron variant started in those countries. Now we found out that it was actually in Europe a week before it was discovered in South Africa. So there's also a level of feeling of unfairness in what was being done.
So just to be clear around these border closures now, as you point out, the variant has been seen in, 24 countries, 5 continents. Are you saying the borders should be reopened with the Southern African nations?
I'm saying that it should not have been closed so hastily until we had a bit more information on the Omicron variant, where it was coming from, what impact it would have. And as I said, it was discovered, it's been in Europe, even before the South African researchers put this out. So I think we ought to reflect carefully how we handle these types of information, because it serves as a disincentive. If you feel that you let out information and the immediate consequence is negative on your country, it gives pause. I think we should reflect on the actions we take. That's what I'm saying.
As you know, Dr. Ngozi, there are a lot of organizations that believe that there needs to be very rapid movement on the issue of patent waivers for these vaccines. And there are some WTO members that are still obstructing approval of a fulsome patent waiver. Is there any way that those conversations could be had virtually if it's necessary to see faster vaccination take place in the light of this new variant?
Absolutely. And I am absolutely in agreement that in light of this new variant, we really have to treat this with a sense of urgency. We must get an answer on the issue of the IP waiver. And work is continuing. It's been stuck for some time. I've said that very clearly. But I think there's a new sense of urgency, and the proponents and the non-proponents beginning to come together to have informal discussions on how to move this forward. It's happening both at the ambassadorial level here in Geneva, but also, like you said, we're trying to find creative ways virtually for ministers to meet from countries, some groups of countries that have opposing views, so that they can work together. I think, as you know, the WTO is a negotiating forum, so we can't have a situation in which there are two polarized sides. We have to bring them to the middle. So that's very much the work we're trying to do now, to find a way forward that could maybe not give everything that each side wants, but would be a satisfactory answer to the situation. So that's what we're working on. That work now is resuming, and everybody has a sense of urgency about it.
Director General, thank you so much for giving us your time. Always good to catch up with you. Dr. Ngozi Okonjo-Iweala, the Director General of the WTO. We're going to wrap up Squawk Box. Thank you for your company this morning. As we leave you, we have European markets mostly in negative territory at this hour, following on from what was a weak session in the United States overnight. But we'll hand you safely on to street signs and the rest of the business day. Thanks again for tuning in.
Good morning, everybody, and welcome to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. European equity markets slump as Omicron variant fears spread, and the U.S. records its first confirmed case. As nations weigh fresh restrictions and shutting down travel, the WTO's Director General tells CNBC vaccine inequity needs to be addressed as a matter of urgency.
If we continue with the inequity, that will have a dampening effect on recovery in those countries. And if you couple that with closure, not allowing those countries to travel or people to come in, I think that is really, that puts a dampening edge on recovery.
Crude prices rise as the market expects OPEC Plus to slow the supply of additional oil when they meet today, amid fears the new variant will hit demand. And Ukraine vows to exercise restraint, saying it has no intention to provoke Russia as Moscow builds up troops on the border.
We don't know whether President Putin has made the decision to invade. We do know that he is putting in place the capacity to do so on short order.
Well, a very good morning to you and welcome to the program. The volatility continues this morning. European equity markets down 1% this morning after a strong session yesterday. We did get a weak handover from Wall Street with the S&P ending 1.2% lower yesterday, the Dow Jones falling more than 460 points, and the NASDAQ dropping about 1.5%. That sell-off came late in the day, so European markets were immune yesterday. So a little bit of a catch-up trade perhaps taking place this morning as fears around the spread of the Omicron variant continue to hit sentiment. Countries across the world debating new measures. Also, technology shares suffering some fairly steep losses this morning. The chip makers in particular. We'll go into that story in more detail in a minute. Here's the picture from a regional perspective. It's red across the board, so fairly broad-based selling taking place. We've got about 1% worth of gains for the DAX, the FTSE MIB, and the Swiss market, as well as the CAC 40. The FTSE 100 holding up a touch better, but still down about 0.7%, and the Spanish market down about 1.2%. From a sector perspective, this is what the split looks like. Every sector is trading in the red. Travel and leisure underperforming, down about 1.6%. Telecoms down 1.7%. The clear underperformer this morning, technology down 2.5%. And within that basket, we've got the chip makers suffering particularly hard losses. On the flip side, we've got oil and gas showing some resilience this morning, down just 0.4% as crude prices are trading higher this morning. We've got OPEC Plus in focus meeting today. Healthcare, food and bev, and chemicals are more resilient than the broader market. But again, every sector is trading down. Air France-KLM is reportedly considering shelving its planned capital increase. The French-Dutch carrier was hoping to raise 1 billion euros by the end of the year. But according to sources speaking with Reuters, tougher travel restrictions caused by the emergence of the new Omicron variant are forcing a rethink. So we've got Air France-KLM shares down 1.7% this morning. Shares in travel companies around the world have plummeted since news of the new variant. And this morning we are seeing more losses come through. A little bit of outperformance from EasyJet up 1.4%, as well as IAG up about 14 basis points or so. But overall, the travel and leisure sector is trading lower. Now moving on to technology. Apple has reportedly told component makers that demand for the iPhone 13 has slowed amid longer wait times. The company has already cut production of its latest smartphone by 10 million units due to an ongoing semiconductor chip shortage. Now, just last month, CEO Tim Cook also warned that the impact of supply chain issues could get worse during the critical holiday season. And as you can see here, we are seeing a significant pullback in the chip makers. We've got ASML down 4%, ST Micro down 4.4%, AMS also suffering some pretty steep losses, and the Frankfurt listing of Apple down 3.7%. So technology is the worst performing sector in Europe this morning. U.S. futures, let's take a look at how Wall Street is poised to open. Similar to the, we've actually got a bounce back coming through for the U.S. market. Now, interestingly, the Dow Jones set for a 260-point jump at the open. The NASDAQ about 94 points, and SP 500 looking at about a 30-point jump at the open. So we have a little bit of catch-up happening here in Europe after that sell-off on Wall Street. But interestingly, U.S. futures are pointing to a rebound after that steep sell-off yesterday. So in the U.S., we are looking at a positive start to the trading session. We'll see if that positive sentiment begins to filter through to the European session as the morning progresses. Now, global growth is set to continue, but cost pressures associated with supply chain bottlenecks and renewed pandemic fears are contributing to imbalances in the near future. All of that is according to the OECD. In its latest outlook, the organization predicts global growth will rise 5.6% this year and simmer down to over 3% by 2023, nearer to levels seen before the pandemic. The UK and France are expected to outpace global growth in 2021, while the German economy is seen lagging behind, dragging on the euro area. China's growth outlook comes in near the top end of global averages at 8%. Policies may continue to drive elevated earnings and inflation, but the true state of economies will only emerge next year, according to analysts at Janus Henderson, who say rising prices will stoke fears while central banks tweak policy. Jim Solunsky, global head of fixed income at Janus Henderson, joins us now. Jim, thank you for being with us. I want to get your views on 2022 more broadly, but let's just kick off with the volatility and the market action we've seen recently, because the last 4 days have really been quite remarkable, seesawing, both directions in equity markets, in fixed income, in currencies. It's been quite a wild ride. We've got the VIX back up to 31, a 9-month high. How are you feeling about markets here, and what do you make of the recent volatility?
Well, markets hate genuine uncertainty, and that's what we have now. And I think, first of all, sentiment is a big factor here, and we had a lot of crowded positions, I think, in markets. And you get these periods where if you get a shock in the news cycle, like you've had with the new variant, what tends to happen is everyone runs to the same side of the boat at once. And when that does happen, you get severe reactions, often overreactions. I think it takes time to settle down. This is true uncertainty, and markets just struggle with that. And that's, I think, what you're seeing today.
I mean, it seems obvious that the catalyst for this recent bout of volatility was the emergence of the Omicron variant and what this may mean for the outlook. But there was already a bit of an overhang creeping in as investors got used to the idea that central banks would be beginning to tighten policy. So to what extent is this uncertainty actually linked to the Omicron variant versus all these other sort of macro factors just having an excuse or a catalyst to come to fruition?
Yeah, I think that's a very good point, because the timing of Powell's backing away from the transition language that's been so prevalent, I think certainly could have been worse in many respects, kind of happening right at the same time as the new variant emerged. I actually do think that the key drivers of markets tend, I think, over the next year will tend to be the coronavirus prognosis, central banks and liquidity, and then inflation. And so to get two of those three things kind of arising right at the same time, I think was unusual. I do think the central banks beginning to be a little bit more hawkish is probably of equal importance, perhaps even a little bit more importance longer term. So I think they're both coming together to really create this period of volatility that we have.
What does the inflation path look like in your view? Now looking out to 2022, how are you thinking about it when it comes to your outlook for next year?
Well, I think the debate continues to be whether inflation is transitory. And for me, the part that is transitory are the 4%, 5% numbers. But what is not transitory, I think, is this notion that inflation remains above the 2% targets that many central banks have. And so inflation, I think, is probably likely to peak in the first quarter of next year. But that doesn't mean it's coming back down to a level that's going to look like low inflation. And so for me, I think there are some permanent features here. The supply chain bottlenecks that I think have caused some of these inflationary pressures could be worsened a little bit by the Omicron variant. And so I don't think it's going anytime soon. But for me, this is where central banks are probably playing it from the right side here. I think markets were probably going to be more fearful of a sharp adjustment from central banks more than anything else. And so to pull that forward a little bit, to be a little bit more hawkish, to me, is probably the right thing for central banks to be doing. They clearly see that I think by the end of next year, you're likely to be at full employment. You're likely to have closed the output gap, at least in the US. And as that happens, I think it's really difficult for them to remain as dovish, I think, as they have been. The timing was certainly unusual with the new variant hitting us, but again, they have to do this. I think to maintain credibility, they have to do this. And for me, the more gradual trajectory is critical. I think that's a better outcome for markets than something that looks like the Fed or other central banks are falling behind the curve.
Jim, against this macroeconomic backdrop, what are you expecting for corporate earnings next year? It was obviously a blockbuster year in 2021, major earnings recovery. What's in store for 2022?
Well, another very strong year is the answer. Nothing like the blockbuster year we've just had, but corporate health remains, extremely good. Even with rising labor costs and things like that, the outlook for profits, in my mind, remains quite robust. The outlook for growth remains strong. I think the inventory cycle is likely to propel us through 2022. And so for a lot of these reasons, I think more stability, this rotation in the economy to more of an inventory-led cycle is likely to kind of keep the earnings and corporate cycle, kind of powering ahead.
So, Jim, what does this all mean then for credit investors looking into 2022?
Yeah, it's a great question because valuations are stretched. And I think when I look at the credit cycle, I don't see much evidence that the credit cycle is over. Some of those signs that you often get of not just excess leverage, but perhaps a real shock to cash flows or lack of ability to access capital. I'm not seeing any of that evidence. I'm not seeing those pressures. So the credit cycle, I think, is still kind of, moving along pretty smoothly. What is not looking so good are the valuations. So you might say if there's an inflection point here with policy, the credit cycle is in good shape. The credit rally is probably not in such good shape. So I think the rally is probably largely over if central banks are going to move more into tightening mode. But the cycle probably can be an extended one and at least last through 2022.
And Jim, just lastly, we have seen junk bonds begin to sell off pretty heavily amid the concerns spreading around the Omicron variant. Is that a source of worry for you?
I don't think it's a source of worry for me. They were overdue for a correction. I think you had a lot of investors looking for a rally into year end, but the search for income, which has been powerful all year, I think will remain powerful. And if you look at metrics such as the ability of companies to cover their interest payments or leverage, these are all improving pretty rapidly. So for me, those signs that you might expect to see at the end of a cycle are actually moving in the other direction. So I view this as a correction. Clearly, we don't know what the Omicron variant might do to growth, and that's certainly an outside risk. But that said, absent those types of events, I think the credit cycle and earnings and cash flow, and keep in mind that defaults have moved to extremely low levels. I see no reason for that to change at all.
Jim, thank you so much for joining us this morning. Jim Selinsky, Global Head of Fixed Income at Janus Henderson. Now, let me bring you some fresh comments that are coming through right now out of the Russian central bank head, Nabiullina, speaking ahead of the next rate-setting meeting due to take place on December 17th. The Russian central bank governor saying that inflation staying high for long enough could undermine the central bank's credibility. This is speaking at a Reuters Next conference. A harmful policy mistake would be to underestimate inflation risks. In terms of the detail here, Nabiullina saying that preliminary data suggests inflation pressure remained elevated last month. 4 to 4.5% inflation forecast for 2022 is credible. New coronavirus waves can be more pro-inflationary. We don't see a key rate at double-digit levels next year. We don't consider raising the inflation target. Nabiullina also saying that consistency is more preferable in our inflation targeting regime. Weekly inflation data do bother us. And our key objective is to make sure that persistent component of inflation is on track to slow to the 4% target. Our key rate will return to neutral range in 2023. a Russian rate hike above 100 basis points unlikely in December. And again, this is the central bank governor of Russia speaking at a Reuters Next conference ahead of their next December 17th rate-setting meeting. All right, we're going to take a break. Coming up on the show, German leaders are set to meet today to discuss a fresh round of COVID restrictions as cases across the country surge. We'll have more details after the break.
Okay, guys, we did 461 on the first trade and minus 10. And we are in the second trade right now. It's up $120. Okay, the second one we did 405. So we did 3 trade, 405, 461, and minus 10. So the total is $850 for today. All right, that's it for today, and I will be in the chat room to trade Forex and other stuff. I will talk to you tomorrow. Have a good day.